What was behind this rout overnight? Was this one of those normal days, really, of markets up, markets down? Was there anything different about that?
I think it's just that realization that even if we do see near-term inflation peaking, the monetary cycle in terms of tightening certainly has it. So it's this continued catch-up in terms of inflation versus where rates are, and this is likely to be in place for at least going into year-end.
And the hope that we might get some pivot, whether it's this weekend or the next few months from the Fed, is that just false hope at this point?
Yeah, it's still unlikely. So these inflationary pressures, whether it's energy related, whether it's food related, they still need to be contained. This is obviously all ex-China, whose inflation is relatively benign. So it's still something to definitely keep on your radar and closely monitor.
And the investment prescription is?
Well, again, if you have these households who have received all this free money, so transfer of wealth from the federal balance sheet to the household, that's being taken away. You're seeing the cost of things going up, unemployment rates going up. It leads the question, I mean, take, for example, exports. There's no clear visibility from Europe and the US going into Christmas. So it makes this whole demand and sort of where's this demand going to come from? That argument still quite uncertain, hence the volatility we are seeing.
Right. And I mean, it's showing up certainly with equity markets down. Usually it was the bond markets that provided that sort of other anchor, but that's also seeing some pressure too. Is there any value though in fixed income right now with yields or corporate credit? Because you're getting some decent yield right now.
Yeah, look, there's value everywhere. And even when we look at sort of the income story, the dividend yields that companies are still paying, whether it's in developed markets or in emerging markets, places like China, that dividend payout. And during this earnings season, what has been interesting to know in China itself is the payout ratios and the companies really adhering to their policies around dividends and rewarding minority shareholders. So this income or yield acts as a cushion during this period of volatility.
Absolutely. And do you think when you look at earnings expectations, I know we'll get into China a little bit more, but since we're talking about it already, things are quite cheap, multiple-wise. You're still getting revisions lower, though. Does that continue?
Likely to see further deratings of earnings, and then it's sort of that wait and see approach in terms of how valuations stack up once we see this derating period come through.
And relative basis, China against, say, other EM, US and Europe. You were just in Europe, of course.
Yeah, I was just in Europe. China long-term still looks attractive. If you look at April, May, China was outperforming versus the US. Then they pulled back in July. You're probably going to see an outperformance emerge, perhaps, the third quarter, fourth quarter, around the Congress time potentially. Okay. And so China still, relatively speaking, is a lot more attractive from our perspective, and it's being reflected in our regional portfolios as well.
Yes, and outside China, where in Asia looks attractive, and would you be cautious on?
Yeah, some of these ASEAN countries are looking interesting just because as they increase their exports, so they're taking away some of that manufacturing from China. They still have that domestic demand argument, the rise of the middle class. They're looking attractive too, especially at certain valuations, across a number of industries we're looking at. But it's that domestic demand which is really, really key.
Right. And do you think, I think on that point too, a lot of these Southeast Asian countries, and I think Indonesia is a very good example, that's one of the best performing markets this year. So far, that's the only central bank that's been able to hold rates. I think they have a rate decision today. How does monetary policy figure into all of this amid a tightening cycle still, obviously?
Yeah, I think that's why people are disappointed with China, because they're expecting more, because they're at the other end of the cycle or the spectrum in terms of they have the capability to ease. But the conundrum that central banks like the PBOC find themselves in is when you have aggressive tightening from other central banks globally, then the interest rate differential becomes wider, has a knock-on effect in terms of capital flows and currency. So I think that is sort of the reason why haven't you done more? But there are good enough reasons, which I'm sure we'll discuss later, why the PBOC is stuck in this sort of position that we find ourselves in terms of not being able to ease as much as maybe the market was expecting. And this has a knock-on effect also across the region in terms of that sentiment argument.
And it's showing up in the dollar too. Is that, in terms of currency exposure, is there anything compelling on the other side of the dollar story right now for you?
Well, it's going to be interesting to see if the authorities step in to stabilize their currencies. And so I think that's what the currency sort of market's looking at this point in time. But as you rightly pointed out, whether it's the euro or whether it's the Swiss franc or the US dollar, that's where all the flows seem to be headed.
Let's bring back in Catherine Yeung with Fidelity. She's here in our studios right now to talk us through the China part of the equation and the risks involved to gaining exposure right now. What do you think?
Well, it's the risks are known, right? So it feels like we're treading water at this point. So we don't expect to see another inflection point, i.e. another big step down. But at the same time, or at the other side of the coin, so to speak, it feels like this earnings and policy cycle isn't strong enough at the moment to turn things around completely.
Yeah.
So we have this combination of risks, whether it's property, whether it's the impact of the COVID lockdown, whether it's global inflation, and it's just all making people very nervous. And as I said, we're probably not going to see anything really come through until the end of the third quarter, going into the fourth quarter, in terms of a catalyst for an upward move.
And is it, I mean, just looking at it very, very simply, is it because there's just no certainty over what this economy looks like in 6 months?
I don't think it's that. It's not even the cost of money when we look at the property sector.
Well, it's probably not, yes.
Yeah, it's more about which developers could actually go into default. So if you look at where the regulators or the policymakers are, they need to protect policy or protect policy. So, to remove systemic risk. Plus, they need to, from a social angle, ensure that they make up the funding shortfall so these projects are completed to give to these home buyers. And hence why we saw that mortgage issue during summer in terms of, it wasn't that people didn't have the money to pay their mortgages, it was that they didn't want to because they were unsure whether they were going to receive their properties. So it's likely we will see consolidation within the sector. The big guys will get bigger. For example, state-owned enterprises, they made up about 75% of land sales year to date. And this will emerge, so the big guys getting bigger, and then the smaller guys, or the guys who aren't managed properly, will go into default. So it's not the financial integrity or the viability of China isn't at risk per se. It's just we're likely to see this short-term pain because we have seen this China property surge for many years. I
mean, that goes into perhaps the issue that it might not even be a money issue. It's I guess indirectly it's a crisis of confidence, isn't it? And while you have that, there's obviously this risk premium that's built into Chinese assets. What do you do? I mean, it's not as if you can't not be invested. In this market. Exactly.
And then you have what we've seen with the COVID lockdown in terms of the movement of people and sentiment being eroded. So it's taken a toll on consumption, it's taken a toll on industrial activities. At the same time, relatively speaking, China still has a balance sheet should they do supportive measures, as we spoke about the interest rate differential globally. So they still have that tool set. And I think really importantly, when you look at, for example, the story about the consumption, the household savings, the rise of the middle class, albeit at a slower pace, I think really importantly, the rise of the domestic investor, that's going to propel growth going forward. And the opening up of capital markets or growth of the capital markets to replace a lot of those assets that used to go to property, again, is really, really key going forward.
Value over growth.
So value over growth. So you're not seeing those big swings anymore. So value outperforming growth by 10% and vice versa. So it's a bit of a mix. In this kind of environment, though, you're probably going to see earnings from those more value defensive businesses doing better. But certainly this earnings period is important. We are seeing or likely to see further deratings. And again, it's going to just be that moment of pause, looking at valuations, the margin of safety, given the earnings outlook, and where to from here.
Absolutely. Now, as far as back to the consumption story, right, that always seems to be, I mean, at least you talk to CEOs, that seems to be the allure of China still. Weakness or no weakness in the economy. Do you think there's been a change in the Chinese consumption story, at least as it pertains to how you invest around that?
No, I think it's still that sentiment that's dragging the segment down. In terms of that, if we look at overseas markets, that free money being taken away from households, China never had that. So the household savings rate is still very, very attractive. And if you just take an area, let's say, for example, tech and global memory, 40% is consumed in China. Between 50 to 60% is manufactured in terms of global memory in China. So even if you can't find, hypothetically, a good memory name or meet your investment criteria in China, you can go elsewhere. But that consumption market, I think what's key in terms of the consumer story is really finding those brands which are gaining market share. And a lot of them, of course, David, are now local brands.
Yeah, and these are really solid companies. You look at it just from a fundamental balance sheet perspective, not a lot of gearing, for example, a lot of growth prospects. That takes me into the broader, I guess, question. As the final question is, yes, there are issues in China. How much of the weakness in the equity market might also be down to the Fed and friends tightening policy outside?
Well, I think this is more of a global risk. So, China's so different versus the rest of the world on many, many levels, whether it's their COVID policy, whether it's fiscal and monetary policy, whether it's inflation. So it's an interesting dynamic, but it still puts China in a position to, we believe, outperform. And as we've spoken about, a lot of these risks are, in fact, now priced in when it comes to China.